Welcome to the Ultimate Beginner's Guide to Order Flow Trading. In this course, you will gain superior knowledge about the tools of order flow analysis in record time. Technical analysis focuses on analyzing historical data to predict future price movements based on known patterns. In contrast, order flow delves deeper into the dynamics of how prices are formed by shining light on market microstructure, meaning how buy and sell orders are placed, matched, and executed in the market. Order flow analysis possesses tools for assessing price formation in real time, as well as tools to analyze how price was formed in the past. In short, order flow has the capacity to unveil information that cannot be seen with price action reading by itself. So order flow is a great ally for price action reading, as you'll see throughout the course. This course is constructed in a top-down manner. First, we're going to quickly study the auction market theory, which provides the necessary theoretical framework to understand market microstructure and order flow trading. Market microstructure is what allows us to understand the intricacies, pitfalls, and opportunities that exist in the way buy and sell orders are placed, matched, and executed in the market. Next, we're going to delve into the various actionable order flow tools and strategies that are worth paying attention to as a retail trader. You'll learn what tools to avoid and what tools to focus on. Without further ado, let's begin by talking about auction market theory. The auction market theory was developed by Peter Steidelmeier, who was a trader at the Chicago Board of Trade in the 1980s. Steidelmeier also created the market profile method, which I'm going to talk about in future courses, and is similar to the volume profile tool. The auction market theory is based on the idea that the financial market serves as a place to facilitate trading between buyers and sellers in a way that is like the bidding and offering process of an auction. To keep things simple, buyers always want to buy at the lowest price, and sellers always want to sell at the highest price. The point where these two opposing forces meet is what is known as point of equilibrium. It's also referred to as efficiency, balance, or fair value. Notice that auction market theory is based on the fundamental principle of supply and demand in economics. Price is the point where supply and demand curves intersect, meaning the point where buyers and sellers agree. The search for efficiency, equilibrium, balance, or fair value of a market is not static. Buyers and sellers are always changing their perception about the market due to many factors. Such factors include major macroeconomic forces, news events, overall market sentiment, and technical factors, to name a few. When a new piece of information emerges, that changes the perception of buyers and sellers related to the fair value of a market. In other words, it creates an imbalance. An imbalanced market starts the process of price discovery, meaning the discovery for the new fair value. When markets are balanced, they trade in a range. There is no motive for price discovery, since buyers and sellers are relatively comfortable with the perception of value of the market. When markets become imbalanced, we have trends. One fundamental idea here is that markets respond to previous areas of balance and imbalance. Balanced markets, which are sideways, are recognized as areas of acceptance. Imbalanced markets, which are trending, are recognized as areas of rejection. Price tends to be attracted to areas of acceptance and repelled from areas of rejection. All of this, of course, assumes that no new information has affected the perception of buyers and sellers. In auction market theory, we have three main components: price, time, and volume. Price acts like an auctioneer that balances the forces of supply and demand in the market at all times. Time serves as an indicator of acceptance or rejection, like it can be seen in the market profile methodology. The amount of time price spends in a price level shows whether price accepts or rejects that level. Volume helps confirm acceptance or rejection. Areas of acceptance are marked by higher volume, and areas of rejection are marked by lower volume. In auction market theory, we also have the concept of value area, which simply represents the price range where 70% of the traded volume occurred within a specific time period. The price level where the highest volume occurred is called point of control. This value of 70% is based on the empirical rule in statistics, meaning that in a Gaussian distribution, we have 68% of the data falling within one standard deviation away from the mean. Traders round that up to 70%. We'll talk more about this when we look at the volume profile. Keeping these basic principles in mind, it's time now to move on to the subject of market microstructure so that we understand the nuts and bolts of how price action is formed in the charts. This might seem confusing and unnecessary at first, but it's extremely important to understand, otherwise you'll be completely lost later. Let's begin first by talking about the different kinds of orders that exist in trading. To keep things simple, we can summarize order types in two categories. We have market orders and we have pending orders. A market order is an order to buy or sell immediately. For example, if you want to buy at whatever price is being traded right now, you will use a market order. The same is true, of course, for a sell order. A pending order is an order to buy or sell at a price different than what is being traded right now. In that sense, we have two main types of pending orders, the limit and the stop order. The limit order is a pending order to buy or sell at a better price than what is being traded right now. For example, a buy limit order is always below the current price since buyers always want to buy low. A sell limit order is always above the current price since sellers always want to sell high. The stop order is a pending order that becomes a market order once price reaches a predetermined level. Notice that stop orders allow traders to trade in a worse price. Buy stop orders are always above the current price, and sell stop orders are always below the current price. One key difference between stop and limit orders is that limit orders are active, meaning that they are directly placed in the market, while stop orders are inactive, meaning that they are held by the broker. If the market reaches the level where the stop order was placed, the broker immediately transforms it into a market order. That means that only the broker can see your stop orders, but limit orders are visible to the entire market. So to make this absolutely clear, let's analyze the types of orders involved in a simple trade with stop loss and take profit orders. Let's begin with the long trade. Imagine that you opened the long trade using a market order. If the trade was opened with a buy order, in order to close the trade, you need to execute a sell order of the same size, so both the stop loss and take profit target orders of a long trade are sell orders. The stop loss of a long trade is a sell order that is below the price you open the trade, so it's a sell stop order in a worse price. The take profit of a long trade is a sell order that is above the price you open the trade, so it's a sell limit order in a better price. Imagine now that you open the short trade using a market order. If the trade was opened with a sell order, to close the trade, you need to execute a buy order of the same size, so both the stop loss and take profit target orders of a short trade are buy orders. The stop loss of a short trade is a buy order that is above the price you open the trade, so it's a buy stop order in a worse price. The take profit of a short trade is a buy order that is below the price you open the trade, so it's a buy limit order in a better price. One easy way of remembering all of this is that market orders get you filled at the current price, limit orders get you filled at a better price, and stop orders get you filled at a worse price, keeping in mind that buyers want to buy low and sellers want to sell high. Notice also that stop orders can be used either to get out of a trade or to initiate a breakout trade, for example. Recall also that limit orders are active, meaning that they are placed directly in the market, while stop orders are inactive, meaning that they are held by the broker until the market reaches the level where they are triggered. This is one of the reasons you need to choose a reliable broker.